Thanks for joining me today. I'm Eric Brown of Graham Wealth Partners at Canaccord Genuity Wealth Management. If you like what you see today, please subscribe, please hit like and add comments. If you want to get in touch with us directly and looking for more details, love to hear from you. Go to www.grahamwealth.com. Now, talking about today's topic. What we're looking at today is specifically for business owners. So you're a business owner. You have money inside your corporation. Maybe it's in an active corporation, maybe it's in a holding company, but at some point you want to get the money out and you want to use it for other things. That could be retirement, that could be funding your lifestyle, that could be having a little fun. Who knows? You want to get money out of your corporation, but your accountant says, hey, don't do that. You're going to pay a whole bunch of tax. Why would you take more money than you need? So I'm going to talk to you today about 4 ways that are often overlooked for you to get money out of your corporation. The first is individual pension plans and retirement compensation agreements. A mouthful. Typically, as a business owner, you do not have a pension unless you've set it up through a group retirement plan that you've also offered to your employees. But let's talk about what you can do to create your pension through something called an individual pension plan, IPP for short, or retirement compensation agreement, RCA for short, just so I don't have to say those long words again. So here we go. An individual pension plan is something that you as a business owner can set up in your corporation to essentially act like a supersized RSP. You get to put money into this individual pension plan, IPP, which is under your name. Your corporation can get a tax deduction, and it's based on a formula that is more generous than an RSP would be. You can also get, in some cases, depending on your income history, you can get more money put into it as a catch-up contribution room. And there's a whole bunch of complexities and different things that you have to be aware of, but that's the general basics. The RCA is something similar in that it's designed to help you build your retirement nest egg and put money in your name. So what essentially you're doing with both of these programs is taking money out of your corporation, putting it into your own personal name, then when you go to retire, you're ready to take an income. The second strategy that's often used that can be looked at for business owners is permanent insurance. And some people think of insurance as this nasty word, you should never buy it. I disagree. It has its purposes, it has its reasons. There's good plans, there's good opportunities for it. And one of them is to get money out of your corporation. So think of a permanent insurance as an investment. It's something that you put money into, and when you put money into it, it stays until you die. Or if you have another person on it, typically a spouse, it stays until both of you die. And what you're trying to do is take money out, put it into this permanent insurance policy usually for estate planning purposes. There has to be an estate reason. So that could be maybe you want to leave more money to your kids or to charity, or you want to set up a legacy, and that's one reason why you would look at a permanent insurance policy. Once you put money into the permanent insurance policy and both of you die, or whoever's life is insured when they pass away, then it gets paid into the company. And the nice benefit of that is some or all of it gets to be paid out through your capital dividend account. And we won't get into the details of what that is, but essentially it just gets to come out of your corporation. So that's another way to look at it. And as an added bonus, money inside the permanent insurance policy grows tax-free. The third thing that you can look at are for the investments inside your company. Typically, you want to have your investments inside of a holding company, because if you have it in your active business, when you go to sell your business, it makes it a little complicated and confusing because people don't want to buy your investment assets, they want to buy your operating business. But let's say you have investments inside your corporation. One thing that you have to be aware of is that you will pay tax on it, on any gains, on any interest, and on any dividends. And the tax rates on all of those are different, where the interest income is more highly taxable than the capital gains and dividends. So what you're doing with capital what you're doing with corporate class mutual funds is investing in a diversified portfolio, just like you would with another mutual fund, but it's set up in a different structure. So as any other corporation, they get to write off some of their expenses towards some of their gains. So that means that you could pay a reduced amount of tax in any given year, or you could pay no tax in that year as well. Another benefit of a corporate class mutual fund is that if it's able to grow into the future and essentially have a capital gain at some point, you can then sell it, and again, you can use that capital dividend account, and half of that gain can then flow out of your company. The fourth thing that you can look at is something called a split dollar critical illness policy. So a critical illness policy, just a brief summary, is something to protect you if you would get a critical illness. So all of the insurance companies have a list of critical illnesses like cancer, like heart disease, like Alzheimer's. There's 20 to 24 of them, and if you get one of those, then you get an insurance payout. Okay, that's pretty straightforward. The next part of it is the return of premium function. So when you buy an insurance policy, you can purchase a return of premium function on it, a return of premium rider. And what that rider does is, after a certain time frame, typically 15 years, you will get all of your premium back if you decide to wind up the policy. So that means that any money that you put into it, you get back as long as you didn't have a claim on it. And you usually will null and void the return of premium if you have a claim. What you can do actually is have the corporation own the critical illness policy itself, and in your own name, own the return of premium rider. So when you get that return of premium in 15 years, it actually comes out to you personally and in your name. Make sure you discuss this with your accountant as well as your insurance advisor to make sure that you have it set up properly. So just as a summary, there are lots of different ways that you can look at to get money out of your corporation. Maybe some of them you haven't heard of before, or some of them you were wondering about. But if you do want to have more details and have a discussion further, we'd be happy to chat. Again, you can go to our website at www.grahamwealth.com.